Goldman Sachs just said the same thing. They said right before 2008, not something similar. The same thing. I've built companies, I've lost money, I've made money, and I've been in the room when smart people convince themselves that this time it's different. It never is. And right now, the smartest bank on Wall Street sent a note to their own traders using one word to describe what's coming. And it's the exact same word they used in 2007, right before the whole system nearly collapsed. If you have a 401 kilobits, if you have a pension, if you've got money sitting in some target date fund, you never look at, you are exposed to this, whether you know it or not. Nobody called and asked your permission. Your money got put into this bet without you signing off on a thing. So stick with me, because by the end of this video, you're going to understand exactly how this machine works, why the people who built it are quietly getting nervous, and what you personally need to do about it before everybody else figures it out too. Now look, I'm going to pack a lot into this video because this is one of the more important ones I've made, and I want it to actually land. So my team put together a free breakdown with the extra numbers and the data that just doesn't fit into a 25-minute video. It's free, it's in the description. Go grab it. But before you do anything else, hit subscribe right now. I'm not saying that to pad a number. This channel is where I break down money, risk, and business in plain English. No jargon, no spin. And if you're not subscribed, you're gonna miss the next one. And trust me, there's going to be a next one. So let's start with what actually happened in 2008, because most people think they know the story and they really don't. Here's the simple version. Banks were lending money to people to buy houses. Nothing wrong with that on its own. That's how the economy is supposed to work. But then it got greedy. Banks started lending to people who had no real way of paying the money back. No job verification, no income check, none of it. They called them ninja loans. No income, no job, no assets. And instead of keeping that risk on their own books, like a responsible lender would, the banks bundled thousands of these risky loans together into a package, gave it a fancy name like a collateralized debt obligation, and sold it off to investors as if it were safe. And here's the part that should make your blood boil. The rating agencies, the guys whose entire job is to tell investors how risky something is, stamped these packages with a AAA rating. The same rating you give us government debt. They called garbage safe because everybody up and down the chain was getting paid to look the other way. Mortgage brokers got paid on volume, not quality. Banks got paid on fees for packaging the loans. Rating agencies got paid by the very banks whose products they were rating. Nobody in that entire chain had a reason to say stop. And it worked right up until it didn't. Homeowners started missing payments, and the packages that were supposedly safe started falling apart. And because those packages were sitting inside pension funds, inside money market funds, inside the balance sheets of banks all over the world, the losses didn't stay contained. They spread everywhere at once. Lehman Brothers, one of the oldest investment banks in the country, collapsed in a weekend. And Goldman Sachs, right before all of it blew up, sent internal notes warning that things were turning into what they called carnage. That's not my word. That's their word. And it's the same word their trading desk used 2 weeks ago. Now, here's where I need you to pay attention, because this is the part everybody's missing this time. It's not home. It's data centers, chips, and artificial intelligence. Here's how it actually works. And I'll keep it simple because Wall Street loves making things sound more complicated than they are, so you'll stop asking questions. Companies like Amazon, Meta, Oracle, and a bunch of AI startups need to build enormous data centers full of computer chips to run AI. These things cost hundreds of billions of dollars. That's not a typo. Hundreds of billions. And here's the thing regular people don't understand. These companies aren't paying for most of this out of their own profits. They're borrowing it. Think about running your own business and putting every single dollar you make plus a mountain of borrowed money on top of it into one giant bet with nothing held back in case that bet goes sideways. That's essentially what's happening at a scale nobody's ever attempted before. And it gets weirder. A lot of these deals are what people in finance call circular. And one company invests billions into another AI company. That company turns around and spends that exact same money buying chips from the company that just invested in it. Then both sides report that as revenue growth on their earnings calls. Investors cheer, the stock goes up, and everybody moves on. Like something real just happened. It looks like the whole industry is booming because money is literally just moving in a circle between the same handful of players getting counted as new business every single time it changes hands. That's not organic demand. That's the same players trading dollars back and forth and calling it an economy. I've seen this movie before. I sold my company, broadcast.com, to Yahoo right at the top of the dot-com bubble in 1999. And within 2 years, I watched almost every single one of my competitors evaporate because they were built on the exact same kind of circular, borrowed money momentum. Companies spending money with each other, calling it growth, raising more debt on the back of that fake growth, and repeating the cycle until the debt came due and there was nothing real underneath it. It felt unstoppable right up until the day it wasn't. And it never gives you much warning when it flips. Here's another piece of this that should worry you even more than the circular deals. A lot of this borrowing isn't happening in a way you can even see. It's not always a straightforward bank loan sitting on a company's balance sheet where analysts can look at it and do the math. Some of it is happening through what's called off-balance sheet financing. Special entities set up specifically to hold the debt for building a data center so it doesn't show up as clearly on the main company's books. That should sound familiar because that's almost exactly the trick used before 2008 when banks moved risky mortgage debt into separate entities so it wouldn't weigh down their official balance sheets and scare off investors out of sight, out of mind until it isn't. And on top of that, private credit funds, which are basically lenders that operate with a lot less oversight and disclosure than traditional banks, have become one of the biggest sources of money for these AI infrastructure deals. Private credit has exploded into a massive industry over the last several years precisely because it can move fast and doesn't have to answer the same kinds of questions a regulated bank does. That's great when everything's going up. It's a nightmare when it's not, because there's far less transparency about who actually holds the risk when the bill comes. So where does the actual risk sit? And why should you, a regular person with a job and a mortgage and maybe some money in a retirement account, care about any of this? Here's the connection nobody's drawing for you. These massive AI loans don't just sit on one bank's balance sheet where the damage would be contained. They get packaged up, just like those old mortgage bonds, and sold off in pieces to private credit funds, insurance companies, and pension funds. Your pension fund, your target date fund inside your 401 kilobits. These funds are hungry for yield, meaning they want a better return than a boring old government bond pays, so they buy pieces of this AI debt because it pays more interest, which means if the AI spending doesn't generate the profits everybody's promising. And right now, a lot of these companies are burning cash with no clear timeline for when it turns into real profit. The losses don't stay inside Silicon Valley. They flow straight into the accounts of everyday people who never even heard the term AI data center debts. Let me put it in terms you'd actually feel and say you've got a target date fund because you turn 65 in 2045. So the fund is labeled 2045 and you never think about it again. You assume the bond piece of that fund is the boring, safe part, sitting there quietly while the stock piece does the heavy lifting. That's the whole design of these funds. Safety in the bonds, growth in the stocks, but a chunk of what gets labeled as fixed income or investment-grade debt inside that fund today is tied to loans made to build data centers that haven't proven they can turn a profit yet. So the part of your portfolio you were told was the safe part isn't as safe as the label suggests. That's exactly the mechanism from 2008 when mortgage bonds got dressed up with a safe rating and ended up inside funds that were supposed to be the boring, stable part of somebody's retirement. The risk doesn't disappear just because it gets repackaged and given a new name. It just moves further away from the people who created it and closer to people who had no say in the matter. and usually find out about it years later when their statement shows a number they don't recognize. Now let's talk about that Goldman note specifically, because the word choice matters more than people realize. When a bank is buttoned up and careful with its public language, as Goldman Sachs uses the word carnage in an internal note to its own trading desk, that is not a casual word. Banks are lawyered up. Every public statement gets scrubbed for anything that could spook a market or create legal exposure. So when carnage shows up in a private note, that's the closest thing you're going to get to a Wall Street insider grabbing you by the shoulders and telling you something's wrong. And it's not just Goldman. The Financial Times has reported that banks are quietly reducing their exposure to AI-related lending, trimming their positions without making any noise about it, because the last thing a bank wants is to be the one that triggers a panic by being the first to sell loudly. Think about what that actually means for a second. These are the same institutions that spend all day telling their clients and telling you through every headline and every CNBC hit that AI is the future and you should be all in. Meanwhile, on the desks where they manage their own money and the money of their biggest clients, they're moving the other direction. That's not hypocrisy exactly, it's just how the game works. The public message and the private position are two different things, and they've always been two different things. I watched it happen in the run-up to 2008 too. Publicly, everything was fine, housing was strong, the fundamentals were sound. Privately, the smart money had already started quietly reducing exposure months before the public ever heard the word subprime. They'd rather exit quietly and let regular investors, the ones without a trading desk, feeding them real-time intelligence, be the ones holding the bag when the music actually stops. That's not a conspiracy theory. That's just how institutional money behaves. The people with the best information move first and move quietly. The people with the worst information, meaning most of us, find out last, usually after our account statements already show the damage. If you want to know how seriously to take a warning like this, look at the timeline from last time, because it tells you something important about how much runway you actually have. The cracks in the housing market started showing up more than a year before Lehman Brothers collapsed. Two subprime hedge funds run by Bear Stearns blew up in the summer of 2007, and at the time most people treated it as an isolated problem. A couple of funds that made bad bets, nothing systemic. Bear Stearns itself didn't collapse until March of 2008, and even then, plenty of smart, credentialed people insisted the problem was contained to that one bank. It wasn't until September of 2008, more than a year after the first cracks appeared, that Lehman actually went under and the whole system nearly seized up. The point isn't to scare you into thinking a collapse is guaranteed or that it's imminent this week. The point is that these things don't happen overnight, and they don't happen without warning either. There's usually a window, sometimes a pretty long one, between the first credible warning signs and the actual event. And that window is exactly when the people paying attention protect themselves. While everybody else is still being told everything's fine, right now, with this Goldman note and the quiet unwinding happening across multiple banks at once, we may be somewhere in that window. Nobody, including me, can tell you the exact date something breaks, if it breaks at all. But you don't need to predict the exact date to start acting like the window is open. So why isn't everybody talking about this? Why do you turn on the news and mostly hear about how amazing AI is going to be? A few reasons, and I've lived through enough hype cycles to know them cold. First, complexity is a weapon. When something is wrapped in enough jargon, whether it's collateralized debt obligations in 2008 or circular AI financing arrangements today, most people's eyes glaze over and they just trust that somebody smarter than them has already checked it out. Nobody checked it out. In 2008, the smartest people in the room, the ones with the fancy degrees and the models, nobody else, understood were the ones who built the thing that blew up. Complexity isn't a sign that something's been carefully verified, and a lot of the time, it's a sign that somebody wants you to stop asking questions. Second, everybody currently making money on the AI boom has zero incentive to slow down and ask hard questions. CEOs need to show growth every quarter or their stock gets hammered, so they keep announcing bigger and bigger spending. commitments because Wall Street rewards ambition in the short term, even when nobody's sure it pays off long term. Fund managers need to chase whatever's hot or they lose clients to whoever's chasing it harder. So even the ones with doubts often stay in because being wrong alongside everybody else is safer for their career than being right alone. The media needs clicks, and skepticism doesn't get clicks the way a shiny new AI breakthrough does. A headline about a chatbot beating a test looks a lot better than a headline about debt structures, even if the debt structure is the thing that actually determines whether your money is safe. Third, and this is the one that gets people every single time, there's always a story about why this time is different. In 2008, it was home prices never went down nationally. That's just a fact. Everybody repeated with total confidence, right up, until it turned out to be completely false. Today, AI is going to change everything. So the spending is justified no matter what, no matter how it's financed, no matter whether the profits ever show up on the timeline. Everyone's promising, maybe AI really does change everything long term. I actually believe a lot of the technology is real and valuable, and I'm not sitting here telling you AI is fake or a scam. But being right about the technology and being right about how the money got borrowed to build it are two completely different questions. And Wall Street loves getting you to confuse the two. Because if you're busy being amazed by the technology, you're not asking who's actually going to be left holding the debt if the profits show up 3 years later than promised. So here's what I'd actually do, and this is exactly how I run my own money. I don't panic and dump everything the second I hear a scary word. That's not the move. Panic selling is how regular people lock in losses while the professionals who cause the problem walk away fine. Because when everyone panics at once, the pros are already on the other side of that trade, buying up assets at a discount. From people who got scared, what you do instead is get educated about what you actually own. Pull up your 401 kilobit statement this week, not someday, this week, and look at what's inside your target date fund. Most people have never opened that document past the summary page. You're trusting a fund manager you've never met and never talked to make decisions with your retirement without ever checking their work. That has to change starting today. Ask what percentage of your bond holdings or your fixed income allocation includes private credit or corporate debt tied to AI infrastructure spending. If your advisor can't answer that clearly and quickly, that's information too, because it tells you they either don't know or don't want to say. Diversification is not a buzzword people throw around to sound smart. It's survival. I don't put everything into one bet, no matter how good it looks, because I've been burned by looking like a genius right up until the moment I wasn't. And I've made plenty of money by staying boring when everybody else was chasing the next big thing. That's a real skill, staying boring on purpose. Look at your overall exposure too, not just your retirement account. If you own individual tech stocks, if you're in index funds that are now heavily weighted toward the same handful of AI companies, because those stocks got so big they dominate the index, understand that you might have far more concentrated risk than you think you do, even if you never bought a single AI stock on purpose. And stay skeptical of anybody, including me, telling you something is guaranteed. The guys who lost their shirts in 2008 weren't stupid people. A lot of them were sophisticated investors who stopped asking questions because everyone around them agreed on the same story and it felt safer to go along. Don't be that guy. Ask the uncomfortable question, even when everyone in the room is nodding along with the comfortable story. And here's my challenge to you. Before you close this video, go check your 401 kilobits statement. Actually look at it. Actually open the fund fact sheet. Don't just glance at the total balance and close the tab like most people do. Then send this video to one person in your life who has retirement money sitting somewhere they haven't checked in years because they need this information just as much as you do, maybe more, and they're not going to go find it on their own. This isn't about fear for the sake of fear. I've made a lot of money and I've lost a lot of money, and fear never once made me a better investor. But ignorance cost me plenty when I was younger. This is about not being the last one to find out what's actually happening with your own money, because the last one to find out is always the one who pays the most for it. I've seen booms turn into busts more than once in my career, going back to the dot-com crash. through 2008, through every hype cycle in between. And the people who came out fine on the other side weren't the smartest people in the room. And they weren't the ones who predicted the exact day everything fell apart, because nobody actually predicts that with precision. They were the ones who stayed informed, stayed diversified, kept a little skepticism in their back pocket at all times, and refused to just take somebody else's word for it, even when that somebody else had a fancy title and a corner office. If this video actually helped you understand something you didn't before, hit subscribe, because I'm going to keep breaking these things down in plain English as they happen, not after the fact when it's too late to do anything about it. Go check that statement. Do it today, not tomorrow.